to the Q1 FY2025 earnings call of MPS Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need any assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rahul Arora, Chairman and CEO. Thank you, and over to you, sir.
Thanks, Shubhangi. Good evening from Gurugram and a warm welcome to our Q1 FY25 earnings call. Today on the call I have with me Sumit Malhotra, CFO of MPS Limited, Tony Alves, SVP and Head of Product Management at Highwire powered by MPS, Pratna Agarwal, CFO of MPS Interactive Systems and Deputy CFO at MPS Limited. Pratna and Sumit join us from our corporate office in Noida, and Tony joins us from the greater Boston area. Sumit will kick things off in our opening segment today by discussing our financial performance. Then Pratna will update us on our content and e-learning solutions business developments. Tony will then follow up on the progress made in our platform business. Finally, I will provide an update on the progress in AJE and Liberate and my individual perspective on Q1 FY25. Let's get going. Over to you, Sumit.
Thanks, Rahul. On a quarterly basis, Q1 FY25 shows robust revenue growth. We recorded revenue of INR 180 crores on an FX-adjusted basis, which represented 36.3% YOY growth. While there was a PBT decline in this last quarter, that is expected to change quickly. Reflecting on the quarter, I would like to highlight 3 key strategic achievements. Our top 10 customers now contribute to less than 45% of our revenue, a much lower customer concentration than when we started this journey in 2012. Quality of revenue is also improving, with platforms responsible for 30% of consolidated revenue. And third, the theme of improvement in quality of revenue can also be observed through improvement on DSO to 55 days. I want to hand it over now to Pratna to discuss the developments in our CS and e-learning business.
Thanks, Sumit. Revenue in the content solutions business grew by 32% in Q1 FY25 compared to last year. Margins were suppressed to 28.66%, largely due to the acquisition of AJE, which was transitioned to MPS as a loss-making asset, and that is no longer the case. In addition to the acquisition of AJE, the journals component of CS business continued to lead the charge towards revenue growth. Volumes and revenue from our star customer base grew because our service delivery has been among the best in the supply chain as it has consolidated. Additionally, we expanded and grew a recently established revenue stream catering to the journal editorial office. The new offerings placed us in a more strategic position in the value chain and has resulted in new business from net new customers and improved the stickiness and quality of our revenue with existing customers. After the acquisition of AJE, e-learning dipped to the third spot in terms of scale of revenue and profits across our 3 business segments. FX-adjusted revenues grew by 6% in Q1 FY25. And while we were slower than our expectations in the scale-up of this business, I am confident about the final prospects in FY25. This business has 4 operating entities in India, Germany, Switzerland, and Australia. Liberate Learning in Australia is currently leading the charge in scaling revenues at healthy margins. Overall margins in the e-learning business were suppressed in Q1 as we navigated the shift in our operating model that now embraces gig workers. Our order book and pipeline in e-learning is robust and growing. I am confident that starting from Q2, where we expect a major step up in margins, our margins will only improve each quarter as we progress through FY25. I would like to now hand it over to Tony to discuss platform solutions performance.
Thanks, Pratna. Including the acquisition of AJE, the platforms business grew by approximately 80% in revenue Q1 FY25 compared to the same period last year. Product roadmaps were on schedule through the quarter and responded well to customer and market demands. The transition to Think 365 is underway as an active user group meeting this past quarter validated our optimism around Think 365. With respect to DigiCore Pro, we released our sandbox environment to multiple customers, and we are expecting to onboard new customers and migrate existing customers from BenchPress to DigiCore Pro. We're witnessing a flurry of activity and new opportunities in the platform business for the first time since our acquisition of Highwire in 2020. There is clearly a positive perception of us in the research community, which is highly encouraging. Highwire and MPS offer the only serious independent choice since two of our larger competitors have been acquired by publishers. I'd like to now hand it over to Rahul to conclude this opening section.
Thanks, Tony. I'll begin the section by discussing the progress of the two acquisitions. We completed the acquisition of Liberate Learning in September last year. The acquisition shaped our entry into Australia. Our second acquisition of a growing business led to a refreshing change in our modus operandi. We had an opportunity to learn much about what it takes to operate and drive a corporate learning business, which largely differs from our other business interests. As Pratna described earlier, taking a cue from the Liberate management team that is gunning to achieve margins north of 30% in FY25, the rest of the e-learning business has also embraced gig workers. And while this has had an impact on Q1 margins, we are bullish about the change in operating model and its positive impact on our business in FY25 and beyond. Moving on to AJE, the acquisition of AJE has been a game changer for several reasons. First, the presence in China is unique to MPS in comparison to our competitors and helps us participate in true global agreements with our customers that historically have had to compromise on their preferred vendor strategy in the region. Second, we are now closer to the most important stakeholder in the research value chain, the funders. The proximity gives us a strategic edge that we will unlock in the future as the market consolidates. Third, our long-standing partnership with Springer Nature has always had tremendous potential, and now we get to maximize it. Fourth, the AI capabilities acquired through Curie, Lewis, and other AJE tools have tremendous synergies with MPS, both on the efficiency side as well as the revenue side. And finally, the scale that we've achieved now is opening new doors for us, and we expect to hit significantly positive financial metrics, particularly high ROIC and robust organic growth, which are a powerful combination in any acquisition. Our scaling global agenda was off to a robust start in Q1. The global agenda was on point as North America and Europe combined accounted for 74% of revenue in Q1 compared to 91% in the same period last year, and almost 100% in the early days of our journey. FY25 will be a year when we surpass several of our competitors in the market that we serve across research, education, and corporate learning. Markets have taken notice. We are being invited to RFPs and new opportunities that were previously unavailable to us. Scale for them implies resilience, business continuity, and future-proofing that have all become core pillars of supply chain decisions after the pandemic and the recent AI-driven innovations. Global reach into additional markets, including Australia, New Zealand, China, Brazil, and South Korea, implies that we can sign true global agreements with our customers. Let us now open the call to questions.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mahesh B., an individual investor. Please go ahead.
Hi, Rahul.
Hello.
Can you hear me?
I can hear you fine.
Yeah. Rahul, my question is on e-learning. What explains the tepid growth and weaker operating margin in e-learning? And what are white spaces in e-learning segment as of today?
Sure. Thank you for your excellent question. So on the margin side, like I had explained in the previous earnings call, we are taking a cue from the Liberate Learning Group, which basically, outsources as much as 40-45% of the revenue. Now, of course, the balance business cannot get to that level immediately, and it'll take us time to ramp up to anything close to that level. And I had previously explained the several benefits of embracing that model because of the changing demands in media formats, but also, the different types of work that we do. So as a result, in the short term in Q1, we've had a hit in margins in the balance part of the business. Now that this model is stabilizing, we will have to do less internal reviews and less quality checks. Also, as we've reduced headcount, that headcount has exited only at the end of the quarter. So we'll start to see benefits of a lower headcount and heavier outsourcing from Q2 itself. And as Pratna described in her opening remarks, that will only improve with each quarter through the rest of the financial year. With respect to growth, we've seen parts of our business such as Liberate and MPS Europa, the Swiss entity, do really well, growing at about 12-15%. We've seen some softness in the India part of our business because of some customer concentration, which we have navigated through now, and are now quite bullish about the prospects of this business on a going forward basis. Our internal estimates indicate that we should achieve about 12% growth in FY25 in the e-learning business by the end of the year. So at a consolidated level, when you look at the annual numbers back, we should be at about 12% for the e-learning business. And of course, margins will continue to improve. From a perspective of white space, quite a few actually. Firstly, today we operate as a project-based company on the e-learning side. We service both corporates as well as customers in the education side. We are gradually trying to enter the managed services space where rather than just supporting our customers on project-based needs, we're able to comprehensively outsource the entire learning and development function for a large corporate. So that's one white space. The second white space, of course, is on the platform side. We have several offerings that need to be configured for the corporate learning market, and that depending on the product that we do configure, could be many white spaces within that particular white space. The third piece, of course, is also currently we are basically providing the content and the technology to provide the e-learning, but the actual delivery and the training delivery is not something that we currently manage. So training delivery would be another area where we could get involved in. So my top three kind of white spaces in the e-learning business would be managed services, platforms, and training delivery.
So Rahul, on the three white spaces that you mentioned, how many will you develop internally, and how many will you acquire through inorganic route?
So all these three we are planning to, with the exception of platforms, where we are trying to configure some of the existing platforms. So on the platform side, it will be a blend of organic and inorganic. The other two will entirely be inorganic.
Okay, great. So is that your next inorganic opportunity that you're pursuing?
So we're pursuing multiple opportunities, but yes, bulk of our focus is on the education and corporate side, given that we've done quite a couple of acquisitions in the last 5 years already in the research side. So mostly we're pursuing opportunities on the education and the corporate side.
One last question. Do you have any managed service contract at the moment, or are you yet to win any?
We have one. We have one with a large organization.
Could you quantify it?
No, that'll be difficult. We're covered with non-disclosure, so that'll be difficult to do.
Okay. Thank you. I'll come back. Thank you.
Thank you.
Thank you. The next question is from the line of CA Arun Kumar Maruthi from Shubh Labh Research. Please go ahead.
Yeah, hope I am audible.
Yes, you are.
Yeah, thanks for the opportunity, sir. Sir, nowadays many entrepreneurs talk about the AI, and we see everyone want to use the AI for the efficiency and the better experience. So, how we will be leveraging AI sustainably in our solutions? If you can throw some light on that, will be quite helpful, sir.
Thank you. So we've been working with AI for a while now, even before some of these, all this momentum, positive momentum has traveled around AI. As I shared in previous calls, we have an R&D hub called MPS Labs, in which all our initiatives around AI are housed. I think currently we're basically a large majority of our initiatives are focused on driving efficiency. We're seeing these in the areas of content solutions, e-learning and platforms. On the content side, we're doing things around translations, around accessibility, around content generation, content development. On the platform side, things around discoverability and searchability. And similarly, on the e-learning side, when we're building courses, we're leveraging on AI. So far, a lot of this has been around operational efficiency and really driving speed. And in exchange, we've gotten significant volume increases as well as some short-term projects for some of our customers. We do have also, and with Curie and a couple of other platforms, an AI-driven platform approach which adds directly to the revenue. But that's really the play that we're ultimately looking at. That how can we move beyond operational efficiency with AI and actually create AI as a revenue stream. Currently, most of it is service-based. We're typically collaborating with our customers to figure it out with them. And what our view on this is, over the course of the next 12 to 18 months, some of these explorations will convert into deep commitments because these commitments require investments on both sides, investments of time, effort, and money. And finally, once these do go into the deep commitments space, we expect in order for all parties to have a good return on the investment, we expect there to be some supply chain consolidation, and that's again a moment in time where we will see an increase in revenue more directly as well. Okay, sir.
And one question is on the e-learning solution side, so that we are seeing that so many quarter has gone that business is showing some volatility. That we started from the employee count of around 250, then we reaches to the 500, now 300, and the revenue is showing some linearity, but the bottom line is always volatile. So, do we have some plans to make it linear, and also would like to know the hiring target for this year also.
Excellent observation, and thank you for your question. As you rightly pointed out, there's been volatility in the margins, and after the acquisition of Liberate Learning, we've realized that really the way to deal with this is to have an operating model where you have a fixed headcount, but you are able to flex above that headcount through independent contractors, vendor partners, and freelancers, so that you can adapt to this volatility. And basically, what's happening is e-learning is a very big market segment. So when demand does come in, it can be different in nature. So you'll see, for example, for a period of time, you'll get a lot of demand around video-based learning, and suddenly from there you go to immersive learning, and so because e-learning is so diverse and comprehensive, projects that we get A can also be equally diverse, and B you'll see these surges where a certain type of work will be the largest proportion of work that we have. So then when you have that kind of a situation, to have a workforce that to staff the delivery and the workforce for that kind of demand, it gets tricky. So what we've done basically after the acquisition of Liberate is we understood their model because they've always been a very high margin business, and the way they manage it is, they outsource 40% of the revenue. They keep only 60% of the revenue in house, and even what they outsource, it's not traditional outsourcing. They have deep connections with the people that they outsource with. They've been outsourcing to them for over 2 decades. So it's not transactional outsourcing. It's very, very deep connected outsourcing. So that's really what we've done over the last couple of quarters. We've had to take a hit in margins because essentially when you're onboarding external resources, you want to make sure that the quality and the delivery doesn't suffer. So you end up doing lots of additional checks and quality control activities in-house. And as a result, we have obviously seen that kind of dip that we've seen. But yeah, going forward, our model as the revenue grows will be to keep the headcount at this level that you see at. We're not planning to increase our headcount even as the revenue grows, and over a period of time, while we don't think we can get to the level Liberate is at 40% of revenue, we think we can at least get to 20-25% over the next couple of years in terms of outsourcing. So yes, absolutely agree with you that the margins have been a bit volatile, and that's largely because the type of work that we're getting is different every week, every month, and now we figured out a good way to manage that internally.
And sir, the hiring target for the year, if you can share, for the total MPS group.
We are not looking to outside of the acquisitions that have been planned. We are not looking to increase the headcount. We are pretty comfortable with the headcount that we have today.
Okay. Thanks a lot, sir.
Thank you.
Thank you. Ladies and gentlemen, this is a gentle reminder. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. The next question is from the line of Navid Virani from Bastion Research. Please go ahead.
Hello, am I audible?
Yes.
Yes, sir. Thank you for the opportunity. So firstly, my question was around the employee cost and the employee strength. If I look at the employee strength in Q1 FY25 versus Q1 FY24, the headcount has gone up just by 10%, whereas the employee cost, if we see in the current quarter and compare it year on year, the employee cost has gone up by 55%. So can you throw some light on why is there such a situation, or am I missing something here? Can you please help me understand this, sir?
Sure. So just to clarify, so that again, thank you for your question. Excellent observation. Q1 of last year, we did not have AJE and Liberate. As you'd appreciate, both these organizations are largely staffed by employees onshore, so in local regions. So they carry dollar costs. With respect to Liberate, they are operating north of 30% EBITDA margin. So that those employee costs will continue. Having said that, we have offshored a large chunk of AJE. In fact, upwards of $5 million annually has already left the system, and therefore you'll start to see some of that change from Q2 onward. So again, as you rightly observed that the number of employees has not gone up, but the cost has gone up, and largely because these are dollar costs. And as I described, north of $5 million annualized has now exited the system, and which should start showing up from Q2.
Understood. That's helpful. Sir, and secondly was on the extra cost which you alluded to in the answer to your previous question that we had to take in the e-learning segment. So if I want to, just to understand the nature of this cost, was it related to some severance packages that we paid to outgoing employees because we are in a transition phase? So is my understanding correct on that part?
Yeah, so twofold. One is because the model has not settled in, we carried extra headcount for a longer period than was required for the actual execution. So we had some duplicate headcount between internal and external. And second would be, of course, with people leaving, there's additional cost in this period. And again, from Q2 onward, that will not show up.
Okay.
So it's a combination of two factors.
Sure. Thank you. Thirdly, wanted to understand So if I look at the revenue from the geographical revenue mix, the revenue from the rest of the world part has increased significantly. And so just wanted to, clarify, is it contributing to any extent in the margin which we saw, or is it only the AJE plus some cost because of the e-learning transition?
Again, great observation. Yeah, nothing to do with margins. It's basically geographic diversity. Our pricing is pretty similar across the board. The value that we provide is fairly equal across geographies. So we haven't seen any differential pricing in these regions. It's mostly been the costs, like extra costs that have sat in the system, as you rightly pointed out.
So the margin drop which we are seeing on a year-on-year basis is majorly because of AJE as well as some additional costs which we had to take on the e-learning solution, right?
Correct. Because Liberate is not the 30%, so I would not pull Liberate into this, but definitely AJE and e-learning business without Liberate.
Understood. Sir, last one from my side is on, so last time around in the conference call, we guided that we're confident of achieving a 25% bottom line growth for FY25. So if I just do some numbers, I get a understanding that we will have to grow by 36% at the bottom line level for the 9 months FY25 compared to 9 months FY24. So the question is twofold. One, do we still does that guidance stay intact? And secondly, if it stays intact, what gives us the confidence that we will be able to achieve that, given the turning around of AJ is still taking place?
Yeah, absolutely. Again, good question. And your math is correct. Yes, we stay committed to the guidance that we provided in the last quarter, that we will comfortably achieve over 25% growth in earnings. We are sitting already halfway through Q2, so we know what Q2 looks like, for example. That gives us much confidence. With respect to AJE, as Pratna pointed out at the beginning of the call, it is no longer loss-making. It is now already, profitable. Just employee costs alone, we have eliminated over $5 million annually. So you can understand what the level of reduction is that's coming forward. Similarly, on the e-learning side, margins are expected to more than double from as we transition from Q1 into Q2. So there's lots of things that are underway that do not show up yet to the markets. Of course, being halfway into Q2, we heavy into the financial year, we feel very comfortable confirming that our guidance stated in the last quarter holds good.
Perfect. Thank you for all the answers. Wishing you and the team all the best for the rest of the
Thank you so much.
Thank you.
Thank you. The next question is from the line of Rahul from Dolat Capital. Please go ahead.
Yeah, hi. I hope my line is clear.
Yes, Rahul, your line is clear.
Yeah, hi, Rahul. So, just wanted to understand in terms of AG, how we are trending in terms of the growth that we had at the time of growth thought process that we had at the time of integrating it, and how it's shaped up in the 4-5 months that has happened since it has been done. Is it still achieving the kind of a run rate that we expect out of it, or should we think we have to do more pull up in the later part of the year to achieve the run rate that we were anticipating out?
Thank you, Rahul, for that question. Yeah, I think so. We've been pleasantly surprised. As you know, previously when we've acquired businesses that were running losses, whenever we've cut cost, we've seen a massive, decline in revenue. But again, those were more distressed assets. This one is not. This one was slightly mismanaged, but the core business still fundamentally has tremendous strength. This one actually is more similar to when ADI acquired MPS. It's of that pedigree. So from my perspective, I think what's been pleasantly surprising is that the revenue has kind of been range bound, between 1.7 million a month and 1.9 million a month, depending on the month. Because it's got this component of B2B2C, so there is some choppiness every month in revenue, but it's been range bound. Second, a lot of the growth opportunities that we're working on are B2B, which basically means that the ramp up is slower, and therefore we have not seen any of the benefits of the B2B element, which in my view over the next couple of years will be and when I say B2B, I'm differentiating between B2B2C and B2B. In my view, in the next couple of years, B2B is going to be the strongest driver for growth for AJE. As of today, none of those opportunities have been realized in terms of revenue. Yes, we have some sales. Yes, we have some conversations and near final situations, but it's not shown up in the revenue right now. So, we are trending north of 20 million annualized. We've been range bound between 1.7 and 1.9 per month. Feeling very good about that. Of course, fingers crossed, and hopefully this holds up as we progress through, FY25. In terms of the growth prospects on the B2B side, I expect that to, again, travel more in the second half of the year. Having said that, feel very comfortable that the existing, run rate will continue, through that period as the B2B side starts to build up. To give you a statistic, today AJE is 95% B2B2C, and again I'm ballparking here. Those numbers could be 1 or 2 percentage points off, and the rest is B2B. A lot of AJE's competitors, the situation is that 60 to 70% of their revenue is B2B2C, and the balance is entirely B2B. So clearly, even if we benchmark ourselves with some of AJE's competitors, there's a lot of potential, even if AJE had to go alone at this B2B attack. But of course, with MPS's support and opening up AJE to all of MPS's customers, we feel that we can achieve it in a more refined way. So, to summarize, feeling very good about AJE on the revenue side as well as the margin side, and the B2B revenue should pick up in the second half of the year.
So, just a couple of follow-up on that part. So I think from a purely revenue run rate point of view, I think you are on track on what you have initially thought about. And similarly, if you could chart the path in terms of what is the annualized profitability that you might see, I think in the comment that I think we have turned positive in this quarter. Is it on quarter basis or exit basis? What should be the number looking like on this on FY25 and FY26 basis? I think that color would be of great help. And just to ponder further on that B2B2C kind of an element that you B2B kind of an element that you spoke about in the H2, just trying to address, is it something which you highlighted earlier, which was like the current solution is not was internally consumed within the client environment, and now since it's kind of a third party asset, it could be showcased to a much larger audience. Is that the opportunity that you're talking about? And if yes, then how we plan to go about it in terms of go to market and stuff like that? Thank you.
Sure. Again, good question. So on the margin side, from my perspective, we're going to see a sharp increase in Q2 itself because of some of the expenses that we've weeded out. This business is somewhat of an equal split between content and platforms. By the end of FY25, we expect the business to be an average margin somewhere between our content and platform business. So that's the aim as we head into FY26, where we'll have a high margin business in FY26. That is growing similarly to the content business. And then for this particular year, we'll have a sharp increase in Q2, and it'll steadily continue to increase till we get to that level. So our goal is that by the end of FY25, we really get this business, to be similar to, our overall content plus platform margin level. So, closer by the end of the year, closer to 40%. With respect to the B2B2C perspective, before AJE was acquired by Springer Nature, who is one of the world's largest publishers, they actually possessed a lot of B2B audience and customer base. They lost a lot of that under Springer Nature ownership, and this was in fact one of the investment rationales that were provided to us by the investment bankers when this deal was presented to us as well, was that because AJE was housed under Springer Nature, it was thought to be competitive by some of the other B2B potential customers, and therefore they lost out on a lot of the opportunities, and some of the customers even exited. And we're seeing that when we had the conversations with old customers who pretty much are MPS customers as well. We're finding out that they really like the AJE service. They, NPS scores were always excellent for AJE. With them, they were quite concerned that a very important part of the value chain is sitting with a competitor. And now, in terms of reviving go-to-market strategy, the revival is essentially announcing AJE as like we did with Highwire as an independent choice, a choice not owned by a publisher but rather an independent provider like MPS, backed by MPS, which we are showcasing at industry events, associations. We're doing many roadshows. At the end of this month, Tony and I are doing a roadshow in China. Next month, the teams are in the UK at ALPSP. In October, we are at Frankfurt Book Fair. In December, we are at STM Week in London. So there's a lot of, almost every month, we are pushing the message both online and offline. And the account managers that own these relationships have also been educated on what AJE is all about and to land the message with their customers. So as you rightly pointed out, it was captive within Springer Nature. They had acquired this for their own self-consumption, which kind of turned off the marketplace because they thought of it as competitive, given that it was sitting inside of Springer Nature. So this opens up this huge opportunity for us going forward.
Sure. That's pretty helpful. So I was just clarifying, you said by Q4 exit run rate, you should be able to achieve similar to average of Content Plus platform for the AG portfolio and in FY26 on an annualized basis.
Correct.
Okay. Thank you. That's it from me. I'll jump back in the queue.
Thank you.
Thank you. Ladies and gentlemen, this is a gentle reminder. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. The next question is from the line of Sumangal Pugalia from Snap Securities LLP. Please go ahead.
Yeah. Hi Rahul, thank you so much for the explanation and great performance on the acquisition also. So I had a couple of questions. Firstly, on the research vertical itself. With the AGE acquisition and the entire portfolio that you've built over the years, if you can give a sense about our market share in pre-acceptance, post-acceptance. I remember you talking about it being only 1%. So, big picture, how do you see that, going forward? Or are you seeing headway and in particular sub-verticals where you are even seeing much stronger growth and gaining market share from competition? How do you see that broader landscape?
Yeah, so the research market, I think we've got 3 legs, right? We've got the author solutions leg, or the research, the solution leg is pre-acceptance. The pre-acceptance leg. The second leg we've got is post-acceptance related to content and e-learning, and the third leg we've got is software like Highwire. Each of these markets is growing. Within each of these markets, we have different competitors. I would say that on each of these markets we tend to be in the top 5, but not always in the top 3. And the market itself is growing. So for us, it's going to be a combination of just capturing the tailwinds of the market, but also because we are comprehensive. There are 3, like I said, there are the 3 legs that our business sits on. There is no other vendor partner that has more than 1 leg. And as a result, we are also expecting that given the comprehensive nature of our business, we should be able to create, and the global nature of our business now, we should be able to create new agreements that go end to end from pre-acceptance to post-acceptance to delivery through the platform, rather than just participate in each of these individual plays. We are already starting to have many of those conversations. In fact, we have revenue already sitting in our as workflow, which obviously is not very large today, but as proof of concepts. And that will be our ultimate goal, where rather than thinking of this as three sub markets, we think of this as one market that we own. So we go from being someone that was in one market number 3, in one market number 4, in one market number 2, and suddenly we've created an entirely new market that we dominate. And that's really the transition that we're looking to achieve in the research side over the course of the next 12 to 18 months. So I'm very bullish about this particular part of our business. Yes, it's a conservative customer base, and that has always been the challenge. But to simply put, the value to be unlocked here is so tremendous for us as well as for our customers that at the most what we could expect is they will take time to take the decisions, but finally they will make the right decision.
Sure. That's helpful. And just going back to the point you were discussing in the last question on the AGE B2B part, can you just elaborate quickly, like what are the actual services that are not being provided to these B2B customers, or exactly what vertical lines services that would be provided to these B2B customers?
So on the B2B side, just to help you understand the customer is essentially has become, for over a period of time, a subscription business. A business that essentially is a two-sided network. On one side of the network, you have authors creating research content, and on the other side of the network, you have researchers researching content. What an AJE or one of its competitors provides is making sure that the supply side of this network is organized and is delivering in such a way that the demand side of the network is able to capture its needs. So that's really what we are providing through AJE. We are basically providing a comprehensive approach to organize the supply side of a two-sided network owned by subscription companies. So what we are doing, for example, is we are helping a researcher write a grant for an institution. Once the researcher gets the grant, we're helping them structure their paper in such a way that the paper is actually accepted, is in a position to be submitted to an institution or to a publisher. Once they have submitted, there's this massive iterative review process through which we help them, guide them. Think of it like a college application. Once the review process is completed, we then enable them to get accepted. Once they are accepted, we then help them get truly published. And once they're published, we help them get recognized and push, how they are viewed on the platform and help them get the name out there. So it's a pretty significant undertaking. But the value that we're really providing is we're helping the subscription business consolidate the supply side of a two-sided network.
Understood. Very helpful. Last question was on the education vertical. So the cyclicality in the school segment is something you've spoken of. So where do you think we are in the cycle and right now, and what's the outlook for that?
So we are in the feast cycle now, just by the nature of the cycle. Typically, irrespective of the type of government in the U.S., the first year after election, when the new government comes into place, education tends to have a significant boost. Now, how that money is spent may change depending on the government, but typically, post elections, we should see a massive uptake in education spending, because that's one area where the government can quickly show progress. And I'm talking more about the U.S. government right now. So we've entered the feast stage, which then gets magnified in 2025 because of a new government or the extension of the existing party, depending on what happens. So again, we're very bullish. Similarly, on the higher ed side as well, the drive towards going digital and building courseware related revenue has continued. MPS continues to make strides and win proposals and RFPs on that front. So yeah, we're feeling very bullish about this business, which has been under pressure for a couple of years, but is now looking good.
Great. Thank you so much.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit your question to 2 per participant. The next question is from the line of Parimal Mithani from Credential Investment. Please go ahead.
Hello. Can you hear me?
Yes, we can.
Yeah, I just wanted to know between your content and the original MPS and between the new platform, which is the area that is going to grow stronger now, or if you can throw some light on it.
Yeah, I think so. Good question. We report our business as content, e-learning, and platforms, but the markets don't view us like that. The markets view us as a company that has presence in 3 markets: research, education, and corporate. We expect all growth in all these 3 markets. There may be a bit of a small base effect with corporate because we have a low base, so growth may be faster there in the short term. But yeah, it'll be very difficult to differentiate what will grow faster, simply because a lot of this today is now being bundled. They are not being sold in isolation based on our market-based approach. So a couple of years we refined our growth strategy, where we said, instead of going to a customer in the market as here are content solutions and platform solutions, e-learning solutions, we'd go to the market with understand what their problems and use these as tools to unlock those problems through the IP and the tools that we have. So yeah, it's difficult to say what proportion will look like going forward. What I can say is today our business in terms of split is probably 60% research, 30% education, and 10% corporate. That over a period of time will somewhat get balanced, given that we expect growth in both education and corporate, as well as the fact that we planned some acquisitions in education and corporate as well.
Okay. So Rahul, 5 years down the line, how do you see between research, corporate, and education? If you can give your ballpark for us, and the overall growth, if you can domain, that would be much better.
Yeah, I think looking ahead, I think research will continue to be a very strong part of the business. So I would say 50, 25, 25 would possibly be the split. Again, totally guessing because it's hard to predict how each of these components will move. I think what we are confident and have our eyes set on is more the consolidated number, which is revenues north of 1,500 crores at similar margins. That's really what we're focused on. But yes, I think if I had to, stargaze and take an educated guess, I would probably say 50, 25, 25.
Okay. And going on, is it fair to assume that our margins will be improved on a yearly basis since all the acquisitions and most of the things have been sorted out?
Yeah. So as we look towards FY 2028, we are, in order to get the growth, we're looking to sustain margins. Yes, there will be periods where our margins will increase and margins will contract, but really we are trying to, be at similar margins because we also understand that, in order to chase growth, we can't simply, milk the margin. So, even today, this business can easily be run at, 40, 45% EBITDA margins, which we have previously. If you go back 5 years, this business used to be a 40, 50% EBITDA margin business. We're sacrificing some of that in order to chase growth. So we'll feel comfortable that we can chase the growth and achieve similar margins, which is around 30, 32%.
Okay. Thank you very much and all the best.
Thank you.
Thank you. The next question is from the line of Shikhar Mundra from Vivo Commercial Limited. Please go ahead.
Hi, sir. So for the target of 1,500 crores which we are setting for FY27, so what would be the split between the 3 divisions? What are we targeting for each?
Thank you for your question. Again, like I answered in the last call, not really targeting a split because some of this is organic, some of this is inorganic. It's not entirely one or the other. But yeah, like I pointed out, between research, education, and corporate, possibly, this is a very big guess. It's 50, 25, 25, but really the focus is to get to 50-100. We're less concerned about what that looks like in terms of a split.
Okay. And what would you say, like how much of it would be on organic growth and how much would be inorganic going ahead from now?
Yeah. So when we gave this guidance, a couple of years ago, we said from at that time we were trending at 500 crores in revenue annually. We said from 500 to 900, so 400 crores of organic growth, which represented about roughly a 12% CAGR, and the balance 600 coming from inorganic growth.
And so in the last couple of sorry.
Sorry
Yeah.
to interrupt. You may return to the question queue for your follow-up questions. The next question is from the line of Rahul from Dolat Capital. Please go ahead.
Yeah, hi. Just had one question. Was trying to understand the growth part for our content and platform business X of the AG part, because that seems like last 2 quarters it's been kind of a flat to small growth. So what's the color out here with the growth side?
Rahul, sorry, coming across slightly muffled. Do you mind repeating that? Sorry about that.
Is it any better now?
Yes, better. Yeah, better.
Yeah. What I was saying is that if you could share the prospect of content and platform business X of AG part, it seems it's kind of a flat to small growth for last 2 quarters here.
Yeah. So on the content side, we had the scholarly part of our business has been growing, pretty impressive. We've had some softness in the education aspect that has corrected this FY. So both FY25 and FY26, we expect content to start surging independent of AJE. Similarly, on the platform side, we had some modest growth last year. That is also picking up. We've had, like Tony was describing in his opening remarks, we've had a flurry of RFPs. We've also had many renewals take place at higher prices, and we are starting to chip away at our competition. So we're winning deals of the platform business from competitors that are larger than us. There are 2 competitors that are much bigger than us, and we've won at least, I think, 2 or 3 deals in the last 6 months from them. So again, feeling confident about that business as well. So last year was modest. This year on the platform side, will probably be double of what we saw last year. And then from FY 26 onward, we get to the 10-12% on the platform side. So content will already pick up in FY25. Platform, there'll be a big gap that will be bridged this year, and FY26 will be similar to content, 10-12%. And our overall plan, really, we have not built just to make sure that we hit these targets that we're talking about. We have not made some a crazy plan. Our organic growth aspiration is pretty much 12% a year, and we're looking to achieve that across these 3 lines of business.
Pretty helpful. Thank you. That's it from my side.
Thank you.
Thank you. The next question is from the line of Navid Virani from Bastion Research. Please go ahead.
Hi, sir. Thank you for the follow-up opportunity. Just had 2 questions. First one was on the acquisition part. So last time around we said that we will be completing 1 more acquisition by the end of FY25. Just wanted to clarify, are we on track to complete that?
Yes, thank you for the question. Yes, we're still gunning to complete the acquisition. Of course, it's in the works, so it's not done till it is done. But yes, we have things in the pipeline, and there's one that we're actively working on.
Perfect. And the size of this acquisition will be as large as AJ, so I think.
Yes, similar. Similar in revenue. That's what I'll comment on. It's too premature to comment on anything more than that, but similar in revenue.
Sure. Thank you. Last one was, if you can just give me a sense on the revenue growth excluding AJE for this quarter. I mean, Q1 FY24 versus FY25. Excluding AJE, what would be the top line rate? Can you give me that number?
I'll be happy to share that at the end of the year. It's sharing that on a quarterly basis will be tricky for us for comparative reasons, but at the end of the year we'll be happy to share that.
Sure. Thank you. Thank you.
Thank you.
Thank you. The next question is from the line of Yash, an individual investor. Please go ahead.
Hi, Rahul. Can you hear me?
Yes.
Hi, Rahul. Thank you for the opportunity. And first of all, I want to appreciate the great work you and your team is doing from the last several years. So we are part of this family films last several years. And also, so probably most of the callers have covered a lot of the questions I want to ask. But I just want to ask regarding some non-operational things. Like probably in the last call you have hinted about the stock split or something like that. And also I just want to ask about the status of the Bangalore office, which you mentioned that it's in process of sale. Just want to understand that. Yeah, that's it. Yeah, thank you.
Sure. Thank you so much. Yeah, just to clarify, we have not discussed any stock split at the board level. My academic perspective on this is no matter how much you slice the pie, the size of the pie remains the same. At some point, if the community feels that this is something we should consider, we'll consider it. But at this point, we have not considered it. But again, that was what I stated was my individual, highly textbook academic perspective. That's something that we will, of course, have to have a more thoughtful discussion done at the board level. As of today, we have not had this discussion. And if we get sufficient feedback from the community, we will engage in a discussion. And we have not, as of today, received that sufficient feedback, neither at the AGM nor in any of the forums. With respect to the Bangalore property, we do have some, prospects for Brigade Towers, which is one of the properties, which as you know, is up for sale, but nothing that is mature that I can discuss. And also open invitation if you know someone that is looking to purchase anything. Now that you said that you're part of the family, please do send them over our way. We're actively looking to divest those properties because we're not in the real estate business, and we own two prestigious buildings in the heart of Bangalore, and we'd love to divest those assets.
And also a follow-up, Rahul. So probably you mentioned what might be the ballpark number? What might be the price of those buildings? So any valuation is done, right?
I would not know that off the cuff. Sunit, if you're on the call, could you please answer, or if you need more time, we could answer separately.
I would suggest if we can discuss this offline.
Okay. Thank you.
Thank you.
Thank you. Yeah.
The next question is from the line of Krushi Parekh from Pentacle Family Office. Please go ahead.
Yeah, hi. I just wanted one clarity. So the business metrics projections that you have given in your presentation for FY25, does that include any inorganic acquisitions or does it include?
No, it does not include. We haven't signed an agreement, so it wouldn't be right to first include anything. So it does not include any additional. It includes AG and Liberate, but does not include anything that we've not done yet.
Okay, got it. Thank you.
Thank you.
Thank you. The next question is from the line of Mahesh B, an individual investor. Please go ahead.
Hi, Rahul again. What is the percentage of AGE-related revenue from non-Springer customers in Q1 or going forward also?
Yeah, so Springer would be Springer-related revenue would be about 20 to 25%. Again, for giving you a ballpark estimate for comparative reasons, but about 20 to 25% would be related to Springer. So I'm not able to share more than that because it's a highly competitive market.
No, but AGE add 100% of revenue from Springer.
No, that's incorrect. AGE's revenue from Springer is about in the range I described.
Okay. So have you been successful in cross-selling AGE services to customers of MPS?
Yes. So like I said in the previous question, again, very good question. We are having very good conversations. We've had some success, but it's only been 3-4 months. We're very confident that we will land this. but we don't have we have one, maybe two customers where we actually have revenue that you're seeing in the Q1 results, but it's tiny. I would not make a big deal about it. So yes, so that's more things that are underway, but it has not shown up in the revenue yet. But that is the most efficient part towards AG's growth beyond the current level.
So given that you are tracking $20 million run rate, what is the organic growth for AG-related services that you see in FY26 and beyond?
Similar to 10-12% compared to the rest of our other business, 10-12%.
Okay. Thank you, Rahul.
Thank you.
Thank you. As there are no further questions, I would now like to hand the conference over to Mr. Rahul Arora for closing comments.
Thank you, everyone, for your active participation as every time in our earnings call. We appreciate all your questions. They help us to learn and improve. I also want to thank all the stakeholders for their continued support and respect. Please do keep making your suggestions and recommendations. They help us. Our journey together has been remarkable, and we look forward to taking this forward as well. Again, I look forward to your continued support, your wonderful feedback, and partnership mindset. Thank you so much.
Thank you. On behalf of MPS Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.